What if I told you the most powerful financial shift of your life might already be happening and you don't even know it? They call it a bull market, but it's not just a cute name. It's the time when the rich make their biggest moves, when millionaires are minted quietly, while the rest, they scroll, they doubt, they miss out. You've seen it before. 2009, stocks explode. 2020, everyone becomes an investor. Crypto, real estate, technology. But what really happens behind the scenes during a bull market? What signals do the wealthy look for start long before the headlines? Let me ask you, why do markets suddenly rise? Why do some people always seem to buy at the bottom and sell at the top? Why do bull markets feel so good yet so dangerous? Stick around because understanding this could change how you think about money forever. The bull doesn't knock, it charges, and those who are ready ride it. Those who aren't get left behind. But here's the secret. Bull markets aren't luck. They follow patterns, and those patterns are visible if you know where to look. Imagine if you could rewind time. Back to 2009, would you have invested in Apple, Amazon, Tesla? Back to 2020, would you have caught the crypto wave early? Hindsight always feels obvious, but what if you had the tools to recognize the next one before it happens? You don't need a finance degree. You don't need a Wall Street mentor. You just need a map, not a grower, and the will to learn. This video is your map. In the next few minutes, I'll show you what a bull market really is, what causes it, how it affects you, your money, and your future. But fair warning, this isn't hype. It's not a get-rich-quick guide. It's a breakdown of how the cycle of wealth works and how you can stop being a bystander. Because whether you act or not, the bull is still running. So sit tight, because in the next chapter, we're going to uncover how history repeats itself again and again, and why knowing the past can unlock your future. Let's begin. Let's break down the bull market in simple terms. A bull market is a period when stock prices rise consistently, often by 20% or more, after a recent low. It's a sign that investors are confident, optimistic, and willing to buy. The name comes from how a bull attacks by thrusting its horns upward, symbolizing rising prices. Opposite to the bull market is the bear market, when prices fall and pessimism dominates. These two terms are staples in finance and are used by everyone from Wall Street traders to casual investors. But the story of the bull market is more than just numbers. It's about emotion and psychology. When people believe the market will keep going up, they buy more. This optimism fuels the rise even higher. Sometimes it leads to overconfidence and bubbles, but the initial trigger is always a combination of economic recovery and investor sentiment. Historically, bull markets often follow major economic crises. For example, after the Great Depression in the 1930s, the market slowly recovered over years of hard work and reforms. More recently, the 2009 financial crisis marked a turning point. The markets hit rock bottom in March 2009. Central banks, especially the Federal Reserve, slashed interest rates to near zero. This move encouraged borrowing and investing. Slowly but surely, confidence returned. From that low point, the S&P 500 index began a nearly decade-long bull run, one of the longest in history. Many investors who stayed patient during those dark days were rewarded handsomely. But it's not just traditional markets. In 2020, amid a global pandemic, we saw an entirely new kind of bull market, cryptocurrency. Bitcoin surged from a few $1,000s to nearly $60,000 in just months. Retail investors flooded the market, driven by fear of missing out and social media hype. Suddenly, everyone wanted a piece of the digital gold rush. Other regions have their own bull markets too. Take India, for example. With a rapidly growing population and expanding tech sector, its stock market has doubled in size over the past 5 years. Emerging markets like these show that bull markets aren't just a Wall Street phenomenon, they happen worldwide. Understanding these patterns is crucial if you want to participate. But remember, not every rise is a bull market. Short-term rallies happen all the time. A bull market requires sustained optimism, economic growth, and rising prices over months or years. Next, we'll explore the psychology behind these trends and how to spot the real deal. Let's bring the concept of a bull market to life with some real examples. First, the 2009 financial crisis recovery. After the market crashed in 2008, many investors were scared to jump back in, but those who had patience and faith saw incredible returns. From March 2009, the S&P 500 began a historic bull run that lasted almost a decade. If you had invested just $1,000 at the bottom, by 2019, it could have grown to over $4,000. This was fueled by low interest rates and renewed investor confidence. Next, consider the 2020 crypto bull market. Bitcoin started the year around $7,000, and within months, it soared to nearly $60,000. Elon Musk's tweets and social media hype created a frenzy. Retail investors, many new to the market, jumped in with hopes of quick profits. This wasn't just about money, it was a cultural moment that pushed cryptocurrencies into the mainstream. Finally, look at emerging markets like India. With rapid population growth and booming technology sectors, India's stock market nearly doubled in value over the last 5 years. Investors worldwide have noticed the rise of new bulls outside traditional markets. This shows that bull markets aren't limited to Wall Street. They're global phenomena. Each of these examples highlights how different factors, from economic policies to social trends, can fuel a bull market. Recognizing these signs early can help you make smarter investment decisions. The bull market isn't just about numbers, it's deeply rooted in human psychology. One of the strongest forces driving bull markets is FOMO, the fear of missing out. When prices start rising, people rush in, afraid they'll miss the next big gain. This excitement often pushes prices even higher. But FOMO can be dangerous. Sometimes investors get caught up in hype and forget to analyze fundamentals. This leads to bubbles, buying when asset prices inflate beyond their true value, and bubbles inevitably burst. Another key element is overconfidence. During a bull market, people believe the good times will last forever. They ignore warning signs and take bigger risks. Retail investors, driven by social media and viral trends, can sometimes amplify these effects. Remember the GameStop saga or the Dogecoin frenzy? These are examples of psychology fueling market moves. So, how do you stay smart during a bull market? First, don't follow the herd blindly. Second, learn to recognize the difference between a healthy rise and a speculative bubble. Third, always have an exit plan. Markets cycle through ups and downs. No bull market lasts forever. Understanding the psychology behind these cycles helps you avoid costly mistakes and make better decisions. Now that you understand what a bull market is and the psychology behind it, let's dive deeper into how you can truly benefit from it. First and foremost, it's important to realize that timing the market perfectly is nearly impossible. Even the most seasoned investors don't get it right every time. That's why many prefer steady, consistent strategies over risky bets. One of the most popular strategies is dollar cost averaging, DCA. This means investing a fixed amount of money at regular intervals, regardless of whether the market is up or down. By doing this, you avoid the stress of trying to guess the perfect moment, and you reduce the impact of volatility on your investments. Next, focus on long-term growth rather than short-term gains. Bull markets can last years, but they are often punctuated by short corrections or pullbacks. Don't panic and sell at the first sign of a dip. Instead, keep your eyes on your overall financial goals. Diversification is another key principle. Don't put all your eggs in one basket. Spread your investments across different sectors and asset types, stocks, bonds, real estate, even emerging markets. This reduces risk and increases your chances of steady returns. Pay attention to market valuations. When stock prices become too high relative to earnings, it might be a warning sign. Similarly, if everyone is talking about a certain stock or sector and hype is building rapidly, exercise caution. Remember, what goes up fast can come down just as quickly. Developing an exit strategy is crucial. Decide beforehand when you will take profits or cut losses. This could be based on a target price, time frame, or changes in market conditions. Having a plan helps you avoid emotional decisions that can hurt your portfolio. Stay informed and keep learning. Financial markets evolve constantly, and new trends emerge regularly. Reading, following trusted experts, and even learning basic financial analysis can make a big difference. Finally, maintain emotional discipline. The bull market is exciting, but it can also tempt you into reckless decisions. Stay calm, patient, and focused on your plan. In summary, use strategies like dollar cost averaging to manage risk. Think long-term and avoid panic selling. Diversify your investments to protect your portfolio. Watch for signs of overvaluation and hype. Have a clear exit plan. Keep educating yourself and stay disciplined. Bull markets don't last forever, but with the right approach, you can ride the wave, grow your wealth, and prepare yourself for whatever comes next.